Hi, everyone. This is Robert Kientz with goldsilverpros.com. I'm doing the intro today for your feature presentation. Today, I wanted to talk to you about tracking the gold price and give you a simple two-step method for tracking the gold price, which allows you as an investor to predict with reasonable certainty the general direction of the gold price over time. This method is going to save time over technical analysis, which often takes many hours to perform. And it means that you do not have to learn a lot of complicated economic concepts to understand where the gold price is going. Before we talk about that two-step method, I'm going to talk about some correlations and things that don't work for trying to determine where the gold price should be. So correlations that do not work. A lot of people will track Dow Jones versus gold ETF demand. In other words, they'll try to track the amount of investment going into ETFs as a proxy for buying physical gold versus the Dow Jones industrial average as a proxy for the general stock market. And there really isn't a strong relation here. You can see that ETF demand does increase at the same time that Dow Jones increases at the same time that demand for the stock market increases, but it also tends to level off when the Dow is reaching certain heights. And so there's not a very strong correlation here at all. So a lot of people will say, people will get into the fear trade in gold and invest in the ETF if they think there's some uncertainty in the market and pull money out of the Dow Jones. And that's not necessarily the case. A lot of times people will invest simultaneously in both the general stock market and the ETFs like GLD and some of the others, just as they reposition their portfolio. And a lot of people, what they really like to do is they like to invest in the GLD to reduce their portfolio volatility. So a certain amount of investment in something like the GLD, which tends to be fairly non-volatile, can help smooth out the volatile periods during the stock market in which a stock could be going up and down pretty violently, such as what we saw in Q4 2018, and also recently when we had the economic shutdowns. I also wanted to compare the Dow Jones Index versus the gold price itself. Not flows into the ETFs, but the actual price. There's not a strong correlation one way or the other. The gold price is not really in a contrarian trade to the stock market, or does not move contrarian to the stock market. Like I said, people can invest in gold at the same time they're investing in the general stock market. We see a nice uptick in the gold price here, 2009, 2011. But we saw also a strong uptick in the Dow Jones Industrial Index as well. So just because gold is going up doesn't mean the stock market goes down, and vice versa. So two different ways of looking at gold versus the general stock market, both in the gold price and also in the fund flows into the GLD. Another thing that's a misnomer with the gold price is that as physical demand increases, so does the gold price. And there's not a one-to-one correlation here. We're looking from 2010 to 2017. And you can see that there are times in which the gold price rose, but the physical demand was falling, and physical demand rose, but the gold price was falling, especially here in 2012 to 2013, after the last big gold bull market. There was a lot more physical demand that came in after gold price had started to fall from its high in 1900 towards its eventual low in the 1100s. And that was not reflective of what was happening in physical demand. Now, in general, people will demand less physical gold when the gold price is falling, because they may not see it as that safe haven investment. And conversely, when the gold price is rising, more people may tend to get into the physical products, the bullion, the bars, things that you invest in outside of the actual ETFs, which are the paper versions of gold. But it's not a one-for-one match. So if you want to know where gold price is going, you don't really want to track the physical sales, physical coins and bars, or even physical deliveries in the futures market, because it's not a one-for-one. There's a lot of paper trading which really determines the spot price of gold more so than the physical deliveries. So the physical deliveries aren't the biggest indicator of where the gold price is going. Another thing that people have talked about historically is fuel costs in determining where gold prices are going to go. So if you're think about it from a miner's perspective, if you're digging the gold out of the ground, you have to really pay attention to fuel costs, because it's one of your major input costs into the cost of getting gold out of the ground and whether you can bring it to the market profitably. And oil price has historically been a portion of the cost of mining gold, but it's not the only cost of mining gold. I would argue actually that the cost of electricity may be a much bigger input, because that's how you're going to run your mine. Certainly you could run your mine off of diesel fuel, and a lot of miners do that when they first get started, but they all seek to have that land power electricity power so that they can run their mine profitably. So they'll often substitute uh, uh, land power for oil or diesel fuel when they're conducting their mine. And oil plays a little bit of a role in terms of trucking around the product, the door, or the trucking from the dirt to the mining facility. But it's such a small portion of the overall spend in getting the gold out of the ground that oil itself does not have a strong correlation. You can see this start to break down after during the financial crisis, when the oil price fell because there was a deflation in demand for oil, but there was an increase in demand for gold. So oil price fell, gold price continued to rise. Oil price eventually came back up, and then it's fallen. And that's even true. This is graph through 2018, but that's even more true now. You see the oil price hovering around here, but the gold price has come all the way up to past its previous all-time highs to around $2,000, but the oil price is still hovering below. So the oil cost input does not tend to drive up the price of gold, as a lot of people have historically thought. And so really, there's been a very weak correlation between gold and oil price. Now, there is some correlation between gold and energy price, total energy cost in getting the gold out of the ground, but oil is only one of those inputs. There are two correlations that do work very, very well with gold, so I'll show you what those are. And if you track these two easy correlations, it's very easy to figure out where the gold price is going to go on a medium to long-term basis, not necessarily on a day-to-day basis, as it can fluctuate. The first one is looking at gold price versus the industry cost of mining the gold. That's called AISC, or all-in sustaining costs. And there's a couple of different measures of the price of getting gold out of the ground. The cash cost is the actual mining cost of getting it out of the ground, the actual running the mines and pulling the rock out of the ground and getting it through the processing facility. The all-in sustaining cost adds in other things like exploration costs, research and development, general administrative. That gives you all-in sustaining costs, or what's representative of basically every dollar that goes into exploring, prospecting, getting that gold out of the ground, getting it to market, and running the company and all the people it takes to run the company. Well, what you notice in this graph from 2000 to 2018, there's a very strong correlation in gold price depicted in the yellow bars to the all-in sustaining costs for the two of the largest miners, Barrick and Newmont, in that it provided a floor for the cost of gold. The price of gold never fell below the all-in sustaining costs. And in fact, in the early years, up through about 2010 to 2009 timeframe, it tracked the all-in sustaining cost. The price of gold tracked the all-in sustaining cost almost exactly. Then as there was additional demand for gold, and we'll show where that comes from, you started to see a premium between the price of gold and the all-in sustaining cost of getting it out of the ground. And we'll show you what causes this gap to occur in the very next slide. We also have plotted here the all-in sustaining cost for the World Gold Council average cost to get gold out of the ground. This isn't the two largest producers like Barrick and Newmont, but we're talking about all of the gold producers around the world, including the medium and small or junior gold producers. There is a correlation there as well, as the overall cost of, according to the World Gold Council, of getting the gold out of the ground for all providers goes up. It tends to cause the gold price to increase, along with a premium, which again we'll show in the next slide. And then when the cost of getting out of the ground comes down, so too does the price of gold itself. So generally, we're getting less and less rich deposits of gold around the world. However, technological innovation and lowering energy input costs have caused gold to be a little bit cheaper to get out of ground than it has been at certain points of time in history, even though long-term, the overall cost of getting gold on the ground is rising over a long-term basis. But when that rises and falls, it ebbs and falls on a yearly basis. The cost of getting it out of the ground is represented by the AISC, particularly with respect to the majors who are producing large amounts of it. That tends to correlate very strongly with the gold price. So if you see in a coming year that researchers expect the cost of getting gold out of the ground to rise, you should expect that the gold price itself in the market is going to rise as well, because the actual gold price never falls below the actual cost of getting it out of the ground. And there is a premium to that as well, which we'll talk about in the next slide. And you can see that premium here in the high years, 2010, 2011, 2012, when gold was reaching its all-time high of about $1,900, or previous all-time high of $1,900 before we hit 2000 this year. What really tends to provide this premium, and by premium, I mean the price of gold at and above the all-in sustaining cost, as shown in this previous slide, is the amount of ETF demand. And we're talking all ETFs. We're talking ELG, Sprott, all of these ETFs in which investors come in and in a paper format, invest money into paper gold that then creates all of this demand in these ETFs to purchase gold. There's a very strong correlation. We see this going all the way back to the amount of tons being bought in ETFs is almost the exact same correlation in shape between the gold price itself. So as the tons rise in demand for gold through these ETFs, the price of gold rises. And then as soon as the demand falls, the price of gold falls, demand comes back up in the ETFs, gold price rises. It's almost a one-for-one correlation, not quite a one-for-one correlation, but a very, very strong correlation. So what does that mean? It means that the ETF demand really is at the margin. It's the marginal shift in the price of gold over time at and above the cost of getting out of the ground. So going back to the previous slide, the cost of getting gold out of the ground sets the floor for the overall gold price. It never falls below, but when you have increasing ETF demand, that's the premium or the incremental the incremental increase in price that you'll see in gold. You can see this incremental price increase in gold right here with the ETF demand going up, the gold price is going up. That's also reflected in this chart as well. And when the ETF demand goes down, you can see that the overall gold price goes down closer to, as a floor, its cost of getting it out of the ground. So if you really want to know what's happening to the gold price in the next 3, 6, 9 months, watch the ETF fund flows. Particularly watch the fund flow in the GLD, which is probably the most popular ETF investment in which general market investors, generalists are investing in gold. If you start seeing gold in the news a lot and you start seeing these big inflows of funds into the ETFs, the GLD, and all of these other ETFs as well, you can expect that the price of gold is going to rise because there's a very, very, very strong correlation. In fact, that is the strongest correlation. We know from looking at the previous chart, the gold price is not going to fall below the cost of getting out of the ground. So the first thing you want to check is what are the estimates for the next year of the cost of getting gold out of the ground. That gives you your floor if you're making an investment in gold and want to know what your floor is or your worst case scenario for what the gold price will be. And then the best case scenario for the gold price would be is how much ETF demand is coming in. Very, very strong correlation between those two factors. And that tends to drive the gold price over time. So simply researching those two factors and forgetting about all the other ones I talked about at the beginning of the video around the Dow Jones and the cost of oil and all those other things. Don't worry about that stuff. Just look at the overall cost of getting it out of the ground and then look at the amount of fund flows that are going into these various ETFs. That'll tell you the directional price of gold and help you understand whether it's a good time to invest in gold for you or not, or whether it's a good time for you to hold on to your gold or hold on to your cash. And those are the easiest ways to do it. So I hope this has been educational for you guys in understanding two of the main factors for tracking the price of gold and anticipating where the gold price is going to go. I know you guys have a very exciting presentation coming up from a very exciting zinc company that I'm really looking forward to. I'll hang around and watch that video. And until next time, appreciate you guys having me on the program.